Good day to all of you. I am Joyce Vasudevan, Head of Corporate Finance at Hibiscus Petroleum Berhad. The purpose of this presentation is to provide an overview of the proposed acquisition of TotalEnergies Brunei. This is to facilitate your understanding of the transaction so that you are in a better position to make an informed decision when voting at our EGM today. We trust that you have read the contents of the circular to shareholders dated 25th September 2024 in its entirety. The circular is also available on our website, and a copy of this presentation will be uploaded on our website after today's meeting. Our presentation will cover an overview of the transaction and provide details of the key benefits, potential risks, purchase consideration and funding, as well as the outlook of the oil and gas sector. We will then conclude with the view and recommendation of your directors. Let's start with the transaction overview. On 13 June 2024, our wholly owned subsidiary Simpor Hibiscus signed a sale and purchase agreement with TotalEnergies Holdings International to acquire 100% of TotalEnergies Brunei. TotalEnergies Brunei has a 37.5% operated interest in the Block B concession, which contains the producing MLJ field offshore Brunei. The other joint venture partners in this asset are Shell Deepwater Borneo and Brunei Energy, also known as BEST. The Brunei asset is gas producing and cash generating, located in a well-established oil and gas jurisdiction. Importantly, we will be stepping into the role of TotalEnergies Brunei as the operator of the asset, giving us a significant role in its ongoing viability. The concession expires in November 2029, with the option for the joint venture partners to extend the concession for a further 10 years to November 2039. This slide shows a schematic of the production facilities we are acquiring. The field produces gas and condensate from 15 active wells drilled from 3 unmanned platforms located in shallow waters. Gas and condensate are transported onshore via an 85-kilometer-long pipeline to the onshore processing plant owned by the joint venture and which will be operated by Hibiscus. After the separation of gas, condensate and water, the gas is sold to Brunei LNG. It is then liquefied and marketed by Brunei LNG. Condensate is sent to the Syria crude oil terminal to be subsequently sold. There are many reasons as to why we believe this acquisition is one that is value accretive to the Hibiscus Group and our shareholders. We will be covering some of the key benefits in this presentation. The Brunei acquisition is a catalyst towards achieving our 2026 growth targets. Upon completion of the acquisition, we expect our daily production to increase from about 21,000 barrels of oil equivalent a day, or BOE a day, to nearly 30,000 BOE a day. This is an increase of 37%. Our 2P reserves are also expected to increase from 60.9 million barrels to 82.6 million barrels. This represents an increase of 36%. As the asset is already profit and cash generating, the acquisition is expected to contribute positively to the earnings of our group. As an indication of materiality, the profit after tax of TotalEnergies Brunei for the financial year ended 31st December 2023 was 150 million ringgit. And if aggregated with our group profits for the financial year ended 30th June 2023, would deliver an uplift of 37%. Our earnings per share would also reflect an increase of 13.5 cents or 26%. As there is no equity issuance required to fund this acquisition, the earnings per share will not be diluted and will enjoy the full impact of the earnings of the acquired entity. As with almost all our assets, we will operate the Brunei asset as well. As operator, we are in the position to manage and drive work programs and budgets. The phasing of projects allows us to maximize opportunities during high oil and gas price environments and manage costs optimally during low price cycles. As operator, we have progressively developed our capabilities to acquire, operate, and extract value from mature assets over the past decade. We intend to adopt our tried and tested approach for the Brunei asset, which includes implementing fit-for-purpose standards and prioritizing projects based on viability. The expected impact would be production optimization and operating cost reduction. Plans to enhance production and extend field life have been identified, some of which have already commenced. The Brunei acquisition meets both our group's energy transition objectives. One of the decarbonization plans being evaluated is to reduce methane emissions, which is expected to offset 150,000 tons of CO2 annually. Another measure being evaluated to reduce carbon emissions from a low-pressure compression project is a 13 megawatt solar facility. The solar facility is anticipated to offset about 11,500 tons of CO2 each year and generate about 18,000 megawatt hours of electricity per year. Gas is widely viewed as being essential to energy transition as it emits significantly lesser air pollutants and carbon dioxide compared to other fuel sources such as coal and oil. About 84% of the Brunei asset's production is gas, which has relatively low greenhouse gas intensity. The Brunei acquisition is expected to increase our group's daily gas production composition from 36% to nearly 50%. Rystad estimates there is about a total of 2.6 billion barrels of oil equivalent of remaining 2C resources in Brunei. Assuming an average daily production of 220,000 barrels, this translates to over 30 years of remaining resource life to be exploited. As one of the 3 producers in Brunei, we hope that our entry into Brunei will unlock new growth opportunities. This will solidify Brunei as a jurisdiction that is key to our group in the many years ahead. With this acquisition, we will also gain the opportunity to work alongside and collaborate with highly reputable partners, which are Brunei Energy or BEST, a company held under the Brunei Minister for Finance Corporation, as well as Shell, the largest oil and gas producer in Brunei. Gas from the asset is sold to Brunei LNG under a long-term gas sales agreement that expires in March 2033. The gas price is linked to LNG and oil prices, and annual contracted quantities have been agreed up to 2032. Essentially, this transaction will provide our group indirect access to the fast-growing global LNG market underpinned by this long-term contract. A fundamental benefit of this transaction is that we will be retaining the highly experienced and qualified team of TotalEnergies Brunei. Since the execution of the sale and purchase agreement about 4 months ago, we have had the pleasure of collaborating closely with the Brunei team to ensure a smooth and seamless transition. The Brunei team's competence and commitment will be of essential value to our group and will ensure continuity in the business and operations of the asset. This, combined with our Hibiscus proven track record, strengthens our ability to jointly drive the performance of the asset. Moving on to the potential risks associated with this transaction. We have set out several risks relating to this acquisition in the circular to shareholders. Some of the key potential risks are as follows. We expect the acquisition to enhance the revenue and earnings of our group. However, these are subject to changes in oil and gas prices, foreign exchange rates, production performance, as well as operating and capital expenditure. Accordingly, there is no assurance that the anticipated revenue and earnings will be realized. Operational risks are inherent in the oil and gas industry. These include cost overruns due to unexpected drilling conditions or adverse weather. There are also safety and environmental risks such as pipeline ruptures or spills. The non-renewal of the concession agreement after 2029 and related agreements such as the third-party gas agreement and gas sales agreement is also likely to negatively affect our group's financial performance. The reserves of the Brunei asset, as is with other E&P assets, have a finite lifespan. The continued development of new reserves to replace what is produced is needed to ensure the long-term sustainability of the asset. There is no assurance that our initiatives to replenish reserves will be successful. Finally, the valuation is based on projected cash flows that depend on assumptions which may not materialize, such as reserves, gas prices, and expenditure. Any material adverse deviation from these assumptions could affect the valuation, which in turn may lead to impairment loss. Addressing the area of the purchase consideration and how we are funding this transaction. The total purchase consideration is $259.4 million. The deal is structured based on a lockbox concept that backdates the effective date of the acquisition, which is 31st December 2022. This means that all net cash flows that have been generated after this date accrue to Hibiscus. The purchase price is supported by a valuation of $250 million by an independent technical and valuation expert, RPS Energy. This is based on net discounted cash flows of TotalEnergies Brunei from 1st January 2023 to November 2039. The purchase price also takes into account the asset's future prospects and potential earnings and cash flows, as well as the outlook of the oil and gas sector. The second component of the purchase consideration is the net working capital of $14.4 million. As this is a company acquisition, the working capital, including net cash, as at the effective date of 31st December 2022, also accrues to us and is therefore added to the purchase consideration. The purchase price of $245 million US dollars comprises the present value of the asset's 2P reserves and 2C resources of $178 million US dollars, and the present value of future cash flows from third-party gas-related business activities of $67 million US dollars. Under the third-party gas agreement, the joint venture is licensed to produce, process, and sell gas on behalf of third parties. The price of $178 million US dollars translates to $7.40 per BOE based on 2P reserves. And including 2C resources in the calculation, the price we have offered is $5.70 per BOE. RPS Energy, the independent valuer of this asset, also used an alternative valuation method called a market-based approach to further assess the reasonableness of the purchase price of $245 million US dollars. RPS Energy reviewed the prices of recent transactions based on 2P reserves and 2C resources in the region, adjusted for oil prices prevailing at the time of the transactions. Their analysis shows that our implied price per 2P reserves of $7.40 per BOE is the second lowest compared to other similar deals. Actually, the lowest price deal of $6.20 per BOE was our last acquisition signed in 2021 for the Repsol assets in Malaysia and Vietnam. Based on this valuation method, RPS Energy arrived at a valuation range of between $242 million US dollars and $461 million US dollars. Our purchase price of $245 million US dollars is at the lower end of this range. The estimated net closing amount to be paid is $146.8 million US dollars. This is arrived at after making several adjustments as stipulated under the sale and purchase agreement. The closing amount is fully funded by internal cash and available debt and other facilities. There will not be any equity issuance required to close this transaction. Furthermore, identified capex projects are expected to be funded from asset cash flows. Moving on to the outlook for the industry. Due to the ongoing reduction of investments in the oil and gas sector, the supply of oil from producing fields is on a declining trend. However, crude oil demand continues to rise. All three demand scenarios show a significant supply gap building in the not-too-distant future. The gap under the base case scenario requires a cumulative 550 billion barrels to be sanctioned between now and 2050 just to meet expected demand. Similarly, current levels of investment in natural gas supply are insufficient to meet future demand projections. The impact of such supply deficit is seen in the projections by the US Energy Information Administration and RPS Energy. Both organizations project Brent prices to remain elevated in the future years. Summarizing our concluding messages. If the Brunei acquisition is approved by shareholders and proceeds to completion, our group will emerge as a prominent E&P player in the region. We believe that this acquisition enhances our presence in Southeast Asia and is important to our growth objectives. Post the completion of the Brunei transaction, almost 75% of our 2P reserves will be located in Vietnam, Malaysia, and Brunei. In addition, the acquisition brings us closer in achieving our 2026 targets of a minimum of 35,000 barrels a day and 100 million 2P reserves. There is only one condition required to complete the Brunei acquisition: your approval. After having considered all aspects of the acquisition, your directors are of the opinion that it is in the best interest of our group. Therefore, your directors recommend that you vote in favor of the ordinary resolution relating to the acquisition. Once again, we would like to especially thank you, our shareholders, for taking the time to attend this EGM and for your continued support. We look forward to answering your questions. Thank you.